Now we move on to section 212, buying and selling on wholesale markets. So this is the prop trading we introduced in the first introductory video. As we said, just to repeat, what we will analyze in the next minutes is found in commodity trading houses, hedge funds, and investment banks. So if you do prop trading, it means you're not working on behalf of a client, not buying for a client, for example, a retail customer, but instead buying or selling for your own good, just to make a profit. And I found a beautiful definition of prop trading or proprietary trading on the Nasdaq website. They define prop trading, and I find it very blunt and to the point, principal trading in which firm seeks direct gain rather than commission dollar. So the Nasdaq, typical for exchanges, I guess, assumes from the beginning you want to make money. You're in it to make money. And either you want to earn commission dollars by accessing the market on behalf of somebody else. For example, if I buy shares for my private bank account, I need an intermediary, a bank, who goes to the stock exchange and buys the share. And then it's later transferred to my depot. But they, of course, earn a commission for doing that because they provide a service. That's not what prop trading is. Prop trading is the firm seeks direct gain. So they buy and sell on their own behalf. Essentially, we come back to that, always trying to earn revenues from the trade. So essentially, buy low, sell high. Simple as that. Okay, but in order to look closer to that, we define the open position, because that is what we steer. That is what drives our chances and risks. The open position of a prop trader denotes the difference between purchase, buy, and sales, sell, for a delivery period H, for example, 1 hour of a year in the future. So we define OPH, open position in our H, is equal to what we bought for our H minus what we sold for our H. So we can calculate, based on this formula, the open position for all 8,760 hours of the frontier. As long as we didn't do anything, of course, the open position is 0. Now assume we buy 5 megawatt annual frontier baseload contract. Then we bought 5 megawatts for the first hour, second hour, and so on and so on and so on. And we want to analyze the open position for the first hour first. We can, of course, put them in a vector and analyze all 8,760 hours simultaneously. But for the first hour, we bought 5 megawatts, 5 megawatt hours for that hour, and sold so far nothing. So our open position, we are 5 megawatts long. If the open position is positive, that is said, then it's said we have a long position, and that means we bought more than we sold. The open position can also become negative easily. If we sell more than we bought for any given hour, then the open position in that hour is negative, and terminology is we are short in that hour. Okay, so the open position can be positive. The trader bought more than he sold, negative or 0. The open position for a period H, and H again is the delivery period, will change over time the trading period. So here again, nicely put, please differentiate these two periods. The H is the delivery period, and we will later introduce the trading period with another letter. For a prop trader, this can happen through transactions as well as changing expectations for complex financial products, for example, options. If you sold an option, then your open position can change because it's what you expect to sell, and that for the option depends on the price level. So it's a little bit complicated, but yeah, that's how it is. The process of managing the open position is often referred to as portfolio management. That's why I put portfolio management so in the center of the whole exercise. The portfolio management, the process of managing the open position, is at the heart of, for example, making revenues here. When registering the schedule on the day before delivery at 2:30 p.m., each balancing group must be balanced. This means the expected open position for the balancing group must then be 0. This we have to digest. You may have asked yourself, how is this working with the investment bank if they are not interested in physical delivery? Do they actually buy and sell forwards? And the point is, well, we have specified the delivery period can well be in the future. And from the perspective of an investment bank, if again we use the example of the front year, you can of course buy or sell forwards with physical delivery. You can buy today, buy more a week from now, and buy even more next month. That means, yes, on the 1st of January of next year, all this energy you bought with these forwards will be delivered to wherever it was specified, in the worst case, to the door of your office. However, that's not a problem. All you have to do is make very, very sure that you bring the open position, the long position in this case, down to 0 before the delivery period starts. So before the delivery period starts, you can do whatsoever you want, even as a pure financial player. Just as soon as delivery starts, you definitely want to be flat. You want an open position of 0. And this is also encouraged or even strictly enforced by legislation, because especially on electricity systems, we have a very complex physical world behind the scenes, financially speaking. So we are talking in this class about finance, energy trading, portfolio management, risk management. But in the end, there is the physical electricity world behind it. And I asked, please familiarize yourself a little bit with the merit order and why electricity as a non-storable or hardly storable commodity requires that production and consumption are equal in real time. This guarantees a stable grid frequency of 50 Hertz. And that is mandatory. That is very important. Like small deviations are okay, but not too high, because otherwise electrical appliances may get damaged or even the whole system may break down. So we have to make sure, and we is in the short term in the responsibility of the transmission system operators, that we have a stable frequency of, in Europe, 50 Hertz. And thus implying that consumption and supply are equal. And if everybody would just be trading without any reporting, the TSOs would not know what's going on in their grid area. And that must be avoided, because then they could not guarantee a stable frequency and a safe and sound operation of the system. So what has to be done is what you read here in the last bullet point. on the day before delivery. So for example, if we talk about our delivery period of the frontier, that delivery period of the frontier starts January 1st at midnight. And on the day before delivery, in this case 31st of December, so the end of this year, 31st of December, at 2:30 p.m., early afternoon, after we had the day ahead auction, each balancing group must be balanced. For our trading house, this means on the 31st, if we are trading electricity, we have to have by law a balancing group, and we must show there that what we bought is exactly equal to what we sold for all 24 hours of the next day, or to be even more precise, for all 96 15-minute intervals of the next day. That's a requirement by law to enable TSOs to guarantee and provide stable physical operation. So that's meant here in this last bullet point. We have a nice picture on this slide. So the physical world and the energy trading world, which is more organized around schedules and financial products. So the interaction between physical delivery and nomination of schedules is as I just described. We define here a schedule as an energy time series. For example, the 96 50-minute intervals of the following days as a vector are by definition a schedule. Or the 8,760 hours is a schedule. And the base contract for the frontier specifies in a schedule that 8,760 hours of the year you get a flat energy delivery of, say, 5 megawatts if you buy a 5 megawatt frontier baseload contract. And these balancing groups ensure that extraction and injection in the grid are balanced. A balancing group can comprise several 1 or 0 grid users. A balancing group without grid users are power plants or consumers, is called a trade balancing group, in German a Handelsbilanzkreis. And with such a Handelsbilanzkreis, our investment bank can trade electricity. Even with futures, no problem whatsoever, no physical delivery anyway, but even with forwards. But we have to make sure, the investment bank has to make sure that the total of sum of what's procured or bought is equal to the total of sum what has been sold for that period H. So for each hour as soon as on the day before delivery at 2:30 p.m. we schedule the next day. By doing so, the balancing groups help the TSOs to maintain a stable, reliable grid operation. To me, we have to look at this and say, it's actually impressive. It really is impressive how all this complexity of the physical energy world, all these millions of kilometers of grid, all these by now thousands and tens of thousands of generators, millions of consumers, with such a vital commodity. Without electricity, everything would be dark in the strictest sense of the word, but also even more so. Imagine for a moment how bad it would be if for, say, 3 to 4 days you wouldn't have electricity. There is books on that, how damaging and disastrous it would be. So it's such a vital commodity and such a complex physical setting, and still we managed to use all the advantages from the financial world, which also has significant complexity, to interact with it, to the best of both worlds, in my view. So far, we have a liberalized system where we are so much more efficient due to energy trading, portfolio and risk management. And at the same time, so far, we can safely say it has not brought the system close to breakdown in essentially most of the liberalized systems. There, of course, have been problems in some liberalized systems, but it's typically not the aspects we are discussing here. It's typically some grid failure or some extreme weather events the system was not prepared for, but the interaction of the market and the physical reality works, some engineers would probably say, surprisingly well. And I, as an economist, am just seeing the, as I said, huge advantages in terms of efficiency, and I also love the complexity. Okay, if we move on to energy trading, the objectives of energy trading can be grouped in three main groups. The first main group is arbitrage, achievement of risk-free profits from different prices on parallel marketplaces. It can be trading platforms. So if, for example, on the broker screen, you see a very good low price, while on your exchange screen, the price for the same product is higher, you could make arbitrage by buying on the broker screen and selling on the exchange screen. That is, however, rare because there are so many highly trained people watching this, and of course there's also bots, machines watching this. So algo trading is looking for these things, so you hardly find them anymore. But still, it may be worthwhile looking for it, especially if you're in less developed markets. And then there can be regional arbitrage, which could, for example, mean that you buy electricity in market A and also buy the right to transport this electricity to a neighboring market B and sell at a higher price in market B. So if price A plus transportation right is still below price B, then you can make a regional arbitrage deal. And then you can have forward and spot arbitrage, but that's a different story. Okay, in the middle you have speculation. You take an open position in expectation of certain market price developments. So essentially, for example, you have observed that the wholesale price, or the price, the electricity price for the front-year contract has increased for the last month, and you think this now is too high. It's a market exaggeration. It's too expensive. So essentially you're saying the forward or futures price for the front year is above what I expect the spot for the front year to be realized. What do? Well, you sell forward or a future for the front year now at what you consider a high price. And you hope and are convinced, otherwise you wouldn't do it, that you can buy back, in a way, the electricity you sold today at the very latest at the lower spot price level you expect during the delivery period. And if you are right, so what you expect as a certain market price development does manifest, you made money. However, if you're wrong, you lose money. That's why here it's called speculative trading. You truly just act on the belief that you're smarter than the market. Because typically the market price you observed is the market consensus estimate of the expected spot price, plus or minus the risk premium. So typically the market price is a pretty good estimator, because there are so many smart people behind it. There is so much money behind it. And if the market price was distorted, somebody would probably try to use it for his or her advantage. So it's actually pretty self-confident to say, well, yes, we can make money here. But on the other hand, like if you're a highly trained expert, you did several classes on power trading, portfolio management and risk management, on energy management, for example, well, then maybe you are smart enough to pull it off. So that's speculation. Third main area, optimizing procurement and sales. For example, diversification of procurement and sales. So you buy from different sources to balance your portfolio, and you use the market for that. The use of wholesale instruments. You want access to the wholesale market. It's for make or buy decisions. You have a power plant, but you want to hedge your power plant. You want access to international sources of supply. You want to act, or you have to act on wholesale markets for that. So that's the third area. If we now move on to our investment bank, to our prop trader, striving to earn money by doing deals on these markets. Here again, you see what I said. It's simple as that. Buy low, sell high. That is the idea. But of course, calling this simple is an exaggeration. It's very, very hard. But it can be done. And I can tell from experience, it's lots of fun. Okay, so looking at this prop trader, name examples for the three motivations of trading we had 2 slides ago. Arbitrage, speculation, optimizing procurement and sales. Find, as I was doing a lot in the past minutes, to give examples. Energy, electricity, natural gas, whatsoever, frontier, week ahead, include a wind farm, whatsoever. Go for an example for the 3 motivations of trading. And then, in the next step, analyze which are typically performed by pure prop traders. For example, pure prop traders don't have a wind farm by definition. We said they don't have any assets and they don't have any retail customers. So, which types of arbitrage, speculation, and optimizing procurement and sales are typically performed by prop traders? That is my question to you. Think about it. And again, we will answer this in class or send me an email.